Hello, everyone, and welcome back to the Unpolished MBA. As you know, we have been doing this series called The Acquisition Chronicles, and I've been joined by guest co-hosts Kenza Osma and Jed Morris. And we've been having different guests on to really dive deep into some of the things that can go wrong when you acquire a business. Some of the topics we talk about are relevant to any business, whether you acquire it or you start it. And this is one of those episodes. Did you know you can go out of business just because you didn't follow up with your customers to make sure they paid you? I know that sounds crazy because you could be making sales, sending invoices, and still end up broke. And if enough customers don't pay you on time, you could be shutting your doors in about 30 days, 60 days. That's how serious cash flow is. And a lot of people think business is just about making money. But what really matters in addition to that is when you get that money. If you don't have cash coming in at the right time, your business will crash, even if you're profitable on paper. And guess what? This happens all the time. So that's why I have Josh on today, and he's a fractional CFO who helps business owners get their cash flow right before it's too late. So we're diving into the biggest cash flow mistakes that kill businesses and why sending an invoice isn't enough to get paid. Surprise, surprise. Also, how you can fix your collections process so that customers actually pay you on time. And we even discuss why acquisition entrepreneurs struggle with cash conversion cycles. But guess what? AI is changing the game, and in particular, small business finances. So there may be some hope in the near future for helping with this. So again, this episode is more real talk, and it's about the money side of business that too many people ignore until it's too late. So if you've ever worried about not having enough cash in the bank to cover payroll, rent, or expenses, you need to hear this. So let's get into it. Hello, everyone. It's Kenza joining me today. Jed is not joining us today, but we're very lucky to also have Josh. And Josh, I'm not gonna rip
Yeah.
apart your last name. I want you to tell us how to pronounce it.
So it's easy. The J is silent, just Tejjkl. That E is long.
Okay, Tico. All right.
Yeah.
Like it. All right, cool. So you're one of those incredible folks that I've met on LinkedIn who seem really smart on the topic of cash flow management. We've talked about how a lot of acquisition entrepreneurs have run into issues with cash flow conversion cycles, particularly in industries that they're unfamiliar with or haven't worked in themselves per se. And not even just that, it can happen with any kind of business, honestly.
It really can. I see it a lot, not just acquisitions, but owner operators. Sometimes it's founders and sometimes it's people that are second generation. I see a lot of times where people are pretty good at invoicing, but there's not always a collection process. Or they think that, well, hey, our terms are 30 days. That's when we're getting paid, right? Well, not if you're not following up. And that can slowly sneak to 45 days, 50 days, 60 days.
So I'm glad you brought that up because that was actually going to be my first question was things that you've seen with businesses that you're like, well, I keep seeing this happening over and over again, whatever that cash flow mistake is. And it sounds like not having a process for after the invoice is sent, right?
Yeah.
So what
Yep.
do you suggest? What do you suggest?
Yeah. And that's kind of where I start when I meet with a client is just, okay, what is your collections process? Um, if it's 30, if you're giving a customer 30-day terms, are you contacting them on day 25? And are you just sending reminders? You don't have to be rude about it, but it's just, hey, if you're contacting the AP person, do you have the invoice? Do you have everything you need? Is there anything that's going to preclude you from making this payment on day 30? It's just some of the, and having a designated person kind of going through that once a week. And okay, if it gets to be day 30 and no one has paid or you've not received that invoice, well, now we have to pick up the phone. And so now we're going to start calling. If it gets to be day 35, well, maybe the salesperson needs to call. So it's not just falling on the accounts receivable person. So it's some of that, just trying to tweak, but really being proactive on, hey, this is due. What's going to preclude you from making this payment?
Josh, I got a question for you. As you work with business owners and you're advising them on a collections process, what do you typically see as a compensation structure for the key team members who are part of that collections process?
Kind of all over the map. I would even say a lot of times I'm working with really small teams. So it's that's almost moving from, hey, the owner needs to stop kind of working in the business and start working on the business. Actually, right before I left banking, I got a call from a guy who had started a landscaping company. And he said, hey, we're growing like crazy. We're getting all of these customers, but I'm out of cash. And I said, okay, kind of walk me through your process. Who does the invoicing? He said, well, I do. And I said, okay. And who does the collecting? Well, I do. And I said, okay, when during the week do you make time to do those two things? And he said, when I get the chance. Well, that's why you're having a hard time paying, because you're not actually collecting. You have to switch modes from operator mode to owner mode.
Yeah. And what I found in my own business when I acquired, we were a sizable company, 8 million revenue plus. We've had team members in each department. And as a business acquirer, when you're coming in, I think the previous owner has a pulse on the business more than you'll ever develop in the upcoming year or so, or perhaps even longer. And so as in building those financial dashboards and understanding that process, top of the list for things
Yeah.
when you hopefully are in diligence or coming on board, because then you can actually not only validate the numbers, but also stay on top of it.
I just met with an owner this past week and he's actually having a hard time. He hired a new controller and that's a really good move, but she's coming from a level where cash was never tight. It was never monitored. There's always just an abundant amount. And now she's at a small business where cash conversion matters and not giving 45-day terms or understanding just, okay, we need to watch that bank account on a weekly, if not daily basis.
I was going to ask you about that because that question comes up often. How often to monitor the amount of cash in the bank, right? Is that something most folks I know are like, I look at it every day, but it still doesn't tell the whole story if they don't know if they've been paid. They're just like, oh, yeah, it's money in there, right?
Right.
So what
Um,
should they be doing? Go ahead.
I think it's more, it's not so much looking at your bank account. I think that kind of gives you
Yeah.
a little pulse, but it really is looking at your AR report at least once a week and making sure what needs to be collected is collected. Because ultimately it stops with you. And some people don't want to be that squeaky wheel or they feel like they're being rude. But ultimately, you can't pay your bills if you don't have that money.
Right. Right. And it's not rude. It's business.
Right.
So that was going to be the next question I had for you. As Kenza was asking, typically, what kind of compensation structure is it for the individual that's hired to do that, right? So I know some folks that have outsourced it, and
Yeah.
they will outsource it to like the Philippines, for example. And yes, I've hired from the Philippines as well, very professional, get the job done kind of folks, but they're not assertive. And I found that companies that put them in those kind of roles are not successful.
Yeah. That's where it's kind of like you gotta kill them with kindness type thing, but you do have to be assertive. And that's where I think, but building rapport, you don't just want to like call them and say, where's my money? I think kind of at the end of the year, sending a Christmas card to your AP folks and just doing small things, touching base with them. I mean, they're stressed too. So it helps to build a rapport.
Yeah, exactly that, Josh. The relationship matters. Preserving the relationship really matters too, because let's say you fall upon a hard time. I mean, who are you going to call? You're going to pick up the phone and talk to the exact people you built those relationships with to see if there's any sort of leeway, cushion, and they're going to want to work with you, right? Because you're in the ecosystem of either providing them a service or purchasing a service from them. And my last company, sometimes we'd even have to get in the car and drive to the actual property management site, talk to the on-site who could make some of the decisions and remind them that payments are due. And you would think that you didn't have to be as hands-on as that when you buy a business, but if you buy one of a certain size, you do. And I guarantee most businesses are making those types of efforts, and we just don't think about it as much coming in from non-small business space.
So, Kenza, you said a business of a certain size. So, you and Josh may have opinions on what size that is. Like, what are we talking about? Does it need to be a certain revenue size, team size, a number of transactions, vendors, right? Suppliers? What do you guys think?
I'll just give my example and I'll open up the floor to Josh because he's probably the expert on this. But on my end, we had almost 10 million in revenue. We had maybe 10,000 invoices a year. So we needed a team that stayed on top of those things. We had a proprietary system built out to manage all of those invoices and the outreach and a system, right? So this is when we invoice, and we used to invoice by mail, right? So that was a process that we updated along the way because we don't need to pay postage stamps when letters are going in the trash, honestly. Like we can just email,
Yep.
right? And we can see that someone's read it, and then we can call, pick up the phone if we need to follow up. So we had a whole system built around this. It was really important that we collect. It's a major focus area for our industry. And so wherever you can't rely on automation, you have to have people and team members supporting it. But it is possible to automate a lot of that process.
Yeah. And I wouldn't say necessarily it's like revenue sides. It's just how many invoices are you sending a month? And do you have a bookkeeper that can handle the volume, or do you need to start building from there? And depending on, I guess, how in tune you are with your team, you can tell when someone's kind of at their capacity or if they need more. But I think, yeah, a lot of that can be automated. It's just, okay, once it's automated, is someone at least skimming over it to make sure those transactions go where they need to go?
Mm.
And then, I mean, it's to me, like on the AR side, you can have someone who does more than just that function. They just need to be able to do it at least on a weekly manner and follow up.
I know one thing we used to do in corporate. And so this is one of the disadvantages of folks entering the acquisition space, the ETA space with like no corporate experience, like no real like work experience, is that you don't have anything to compare to, right? And so I was just getting to explain it back in my corporate days. We would have an idea, we would gauge, kind of do a risk analysis of who were the riskier vendors versus the others, and ones that we knew we had to follow up on and be assertive or you proactive on. And you don't know that if you've never experienced those things. You don't even know to even think that way. And so that's the part where I really want to emphasize that it's not that you have to be this world-class MBA to run a company or acquire a company, but you want to surround yourself with folks who maybe have that experience that you don't have, because it's serious business once you get out here. So you mentioned about initially that the one company that brought in a controller. Now, most people don't know what a controller does. What's the difference between a controller, a CFO, VP of finance, right? Because when we are looking at these small businesses, they give people all types of titles, right? So
Yep.
you don't really know what folks are doing. So can you describe what those different titles mean and what you think is what's appropriate for a controller to come in, right? As well.
Yeah.
So go ahead and explain, please.
I mean, so really starting with bookkeeping, and that's really just making sure transactions get recorded. I would say kind of going, I mean, you have an accounting manager, controller. That's someone who's actually going to build your financial statements. If you're on accrual basis accounting, they're going to do the accruals. They're going to make sure that the general ledger ties to the schedules. You're probably doing prepaid depreciation, insurance transactions every month. But the controller is the one that's really going in and building the financial statements. They're the ones that are working on month end close. And then ultimately, well, if there's a CFO, review the financials with the CFO. And then the CFO will report to either the CEO or the board, however, kind of on the month end, but then really looking forward, what's coming ahead. And that's where those kind of dashboards and KPIs come into play.
Yeah, that forward-looking part is important when folks really make the differentiation between accounting and finance as well. So
Yeah,
that
I always like to tell people, like, I can do debits and credits, but I'm much better looking forward than I am looking backwards.
yeah.
I have a question. This is probably a softie, but I've always been curious. Small businesses that I've come across as a broker or business buyer, a lot of them are on cash basis. They're not usually on accrual. So I think there's a $25 million revenue requirement where you're obligated to switch, right? But in your eyes, if a business buyer is coming on board to a new business, how do they get that forecasted look without making that accrual switch? What are your general thoughts on making the switch from cash to accrual?
So as big of a cash flow fan as I am, I think the accrual basis gives you a better look. It at least smooths out the revenue. There are other things you can do if you're on cash basis. I mean, you can keep kind of a backlog and but it's more work than anything. I think saying that revenue is the cash that hits your bank account isn't really all that productive. And I don't think you need to get every accrual right, but there are little things that just, okay, let's invoice when the work is complete, not just like say, hey, the revenue is when it hits our bank. There's just things you have to work around if you're on cash basis, like what's coming up next.
I've got a great example for you if you want to pare it down. Okay, so I bought a company in the real estate space and we were on cash basis for the tax returns, right? I didn't know, or it was not disclosed to me that we receive payments on invoices in two ways: through paper check, that's in a PO box. That's fine. I understand that. The second one was through online payment portals, right? And those payment portals have credit processing fees. So if you're only provided cash basis financials and your AR is not on the balance sheet, it's maintained in a separate system and payments are coming in through those payment portals. And we don't account for any of those fees on our actual P&L because it's all maintained in outside systems, that it doesn't create enough mismatch to where your spidey senses would go off in a Q of E. Like there's something to dig into a little bit more. It's a small business. I get it. It's not a dollar for dollar match, but it does create a huge impact in how you manage the cash flow and how you pay your people, because essentially the company's eating a bunch of those fees, but they're not passing them on to the contractors. So it was a little bit of a hornet's nest. Does that sound like a hornet's nest to you, or am I just overly sensitive to this because I got burned?
No, but I think one of the first things I love to implement as well is a 13-week cash flow forecast. So regardless of how you're doing your accounting, just, okay, what's in your bank today? What are you expecting to come in and what are you expecting to go out? And it's never going to be dollar for dollar accurate, but it gives you that kind of signal. Are we heading in a direction where things could get ugly? Or maybe we're heading in a direction where cash is going to start to pile up on the balance sheet and we got to think about where to reallocate it.
That's a nice problem to have, right?
Yeah. I mean,
I'm just saying, as a consultant, of course, for my tax purposes, it makes sense to do cash, right?
yeah.
Not accrual basis. So I would just say it depends on the business, what makes sense as well. But also, I think, particularly in my case, if there's any consultants out there, I know tons of you guys listen to me because we're in the same space, but I was always concerned about paying taxes on revenue I didn't have.
Right.
So
I mean, I think, and I'm not a tax expert by any means, but even if your books are accrual based, your tax accountant would follow you as cash basis.
Ah, okay. All right. So you guys heard that. Josh is more of the expert on these things.
So what you're
Josh?
saying is you can still file on a cash basis, but you can manage the company on an accrual basis. And
Right.
that's kind of like the unlock, basically.
Yeah. Just like you can accelerate depreciation, right? And I think you should do that on a tax return if it's beneficial for you. But when you're actual operating your company, you should just use straight line and allocate that over a period of time.
I have so many follow-up questions, but I'm only going to ask one, if that's okay.
No,
Oh
ask
yeah.
more. Come
Uh,
on.
so if we do have accrual basis financials, then you can write off bad debt, right?
Yeah.
Okay. So it's more of a question with like a tax CPA accountant advisor on like what you really want to do. I honestly didn't even get there with my company. You haven't probably heard this story, but I would characterize it as a little bit of a dumpster fire. And there's so much that you learn afterward because it was mainly like a cash flow forecasting exercise for an extended period of time because we were in constant upheaval. And I remember at one point, I actually drafted a letter to my team saying that we were going to shut down. We made it past this. It didn't happen, but I had the letter ready because I saw what was in our bank account and like maybe people could pick up on some of it. I'm sure they did because they're smart people, but I don't think they understood how bad it really was that I had drafted a letter saying that we were going to shut down.
I believe it. I mean, and I'm sure they could feel it. It seems when I'm in companies that have cash flow issues, like even if it's not explicitly said, you can feel it in the way people act. There's almost like a tension in the room.
Yeah, absolutely. I mean, I thank the people who stuck around. I'm equally thankful to the people who left because they gave us opportunity to change our expenses, change our operating costs. Like things needed to change and change is uncomfortable, but it's even more uncomfortable when it's in a turnaround.
Absolutely.
So for Josh, for a business that's struggling with cash flow, finds themselves in that situation, where should they start when trying to improve the situation?
Yeah. I mean, I love to start with gross margins. And I think you need to figure out what are your actual costs to sell or build whatever you're building and be honest about that. Do the unit economics work? And then really, I would, with a fine tooth comb, go through your operating expenses and just say, if we need to, if we need to cut 5% today, where do we start?
Hmm.
Is it salaries? But what are we spending on software? Are we duplicating things across the company where we could consolidate? I mean, your biggest expense is usually people, as tough as that is to say. And so you have to be hard on those. There's a Bob Pfeiffer book, I think is his name, called Double Your Profits. And he has a quote that I love that expenses are like fingernails. You have to constantly be trimming them. And I think that's something that gets away from people. So I would start there, but I would be looking at if you have inventory, how long has it been sitting? If your sales are declining, but your inventory is going up, what's going on there? Yeah, I'm a big fan of the cash conversion cycle. Can you speed that up? Same, I was having a conversation the other day of it's not unreasonable to ask for down payments, especially if you're doing custom work. I mean, you have to fulfill your duty and earn that. But if you're creating a product that you have to buy materials for and you have to make some investment into, I don't think it's unreasonable to say, hey, we need a 25 or 50% down payment and then you pay the rest at the end. But you really have to figure out, is it an income statement problem or is it a balance sheet problem?
Explain
And
that
that,
for those non-MBA folks. And
so
since
are you just not making enough money? Or is your profit margin less than 10 or 5%? Or do you have so much wrapped up? People talk about working capital, but it's really your operating assets, which is AR and inventory. Those are the things you really can control. So do you have too much AR? Are you not collecting? Are you letting people kind of abuse you? Do you have too much inventory? And then sometimes I see on the AP side, people feel that their business is like a personal, or and they're prone to pay their bills as soon as they come in the mail. And it's not. You most of the time you have terms, or if you ask for them, you'll get them. So instead of saying, hey, I received this bill today, well, I now have 29 days to pay it. And then really, if you want to get into it, you can put it on a credit card and extend it for another 30 days and hopefully earn 2% cash back on that. So it's just understanding. I like to start with the income statement. Are you actually generating a return on your sales? And if you're not, well, we have to plug those holes. But if you are, then where's your cash? And it's probably somewhere hidden on your balance sheet.
There's so much to learn from what you just said, Josh. And I think it's helpful for both business owners and business acquirers. Because if you take all of the things you just said and you apply them to a business acquirer, it tells you the type of opportunities that are valuable and deserve a higher multiple and the type of work that you're going to have to do to build out a value creation plan, right? So whenever I talk to folks acquiring, I mean, looking at the unit economics of a company and how it earns money and where the levers really are can be so helpful, because now you're not just saying that like, hey, this is a company that if I add some digital marketing, we're going to like quadruple our leads and things are going to shoot through the roof. What you're looking at is, hey, here's a cash conversion cycle. I think I can shorten the days here, and I think I can delay payment over here. And that's going to mean we got eight fewer days in our working capital requirements. And that means X dollars, right? Like
Yeah.
that's a real thing you can assess in diligence if you get things right, and actually action right out of the gate if it's culturally acceptable. So these are all amazing levers that you can pull and use to assess the opportunity.
Yeah. So I'll follow up on that. And this is gonna get a little nerdy, but you have your gross margin, and then I would say you have your EBITDA margin. And then some people call it working capital absorption. I call it just working capital margin. But essentially, it's your AR plus your inventory minus your AP divided by revenue. And you want to compare that to your gross margin. And there's a name for that too. And I don't necessarily recall, but if your working capital margin is greater than your gross margin, for every dollar you sell, you are burning cash.
Hmm.
And it's not something that is taught in finance classes. It's a pretty unknown concept, but it's great that you can sell all you want. But at the same time, if you have to invest in your balance sheet, you're going to run out of cash.
Is there a particular proportion or ratio that you're looking for? You just don't want it to be equal or exceeding? Like, what is
You,
it? Is there a
you
particular?
want your gross margin percent to be higher than your working capital margin. And then, I mean, the smaller it is, the tighter it will be, but you certainly don't want it to be negative.
Got it.
So when buyers assess opportunities, when they're looking at the debt service coverage ratio with lenders, there's a ton of calculations going on behind the scenes. There's also a view in which a buyer should really be looking at the free cash flow as opposed to adjusted EBITDA. So can you just talk a little bit about those two different concepts and buyers should really be doing to assess an opportunity?
Yeah. I mean, I stole this, so it's not mine, but adjusted EBITDA doesn't pay the bills, right? So my favorite metric is the operating cash flow, right? So what's your net income plus your non-cash charges, and then changes in your operating assets. And that really kind of tells you. But then you can, I mean, depending on the type of business, like what's the CapEx requirements? What are you going to have to spend year one? Do you have to buy equipment? Do you have to buy new vehicles? Some businesses have really large software spend. Like, are you required to keep that program? I think you really have to drill down on the statement of cash flows, right? I mean, some of these things, there's opportunity where you certainly can clean some of it up, but you need to historically look at how much do we need to reinvest in the business going forward. Depreciation in 1 year is non-cash. Depreciation over time is a real charge. And so it's understanding that. What's maintenance CapEx? What's growth CapEx? If you want to grow, how much do you need to reinvest or invest in new capacity? So for me, it's understanding free cash flow. I'm a huge fan of just the operating cash flow, but you need to understand the entire balance sheet.
You make some great points, Josh. And I've found that even for the sellers who have been operating these businesses for decades, they don't have the depth of understanding of the financial statements that you do or other professionals in that realm. So, and then you're taking over a business, right, where they don't quite know what's going on. They don't know if the statements that they printed off from QuickBooks or gotten from their accountant, what they mean. Makes sense. They
Right.
just know it's money in the bank. What can a buyer, let me ask you this. Let me word it a different way. Who should be in the room? Who should be that team of advisors to break this apart, really understand it as someone is trying to decide to move forward?
Yeah. I'm kind of mixed on quality of earnings. Um,
Please
I
share
think
why. I'd love to hear your insights.
I think they're valuable. I think from a diligence standpoint, they really can pinpoint stuff. Sometimes, look, I mean, we're all professionals, but I don't know sometimes if the price paid for a proof of cash is really what it's worth. If you normally people can find someone like, okay, let's collect the bank statements. Let's look at the general ledger. We can piece those things together pretty quickly and just, okay, do the statements match? Are they getting what they said they were getting? But yeah, I mean, I would say like, do you know which accounting program you're going to use day one? And then who's going to be handling that? I wouldn't be opposed to outsourcing that, but I would make sure that I was having a recurring meeting pretty frequently to say, okay, where are we and what's going on? On the deal side, I would absolutely get someone who's done an M&A transaction before. I wouldn't use your uncle's divorce attorney.
Mm.
I listen to Acquiring Minds, and so I guess
Yeah.
I should say I come from a credit background, so I'm always thinking about what could go wrong. I think if you do some diligence ahead of time, you want to put as many barriers between something going wrong as you can at the start. So it's just having a deal team that's done some of this before, an attorney that at least will point out risks. It's up to you to make those decisions, but really understanding what's going on. But I think you need to have a financial plan from day one. What can we trim? What do we need to add? And two, understand you can't make every investment you want to on day one. The J curve is a real thing. There are all kinds of low hanging fruit in some of these small businesses, but and you'll get to them someday, but pick your top two priorities and attack those and go from there.
That's great advice. You mentioned of having a financial plan, and to get the money from the bank, the buyers have to do one, but I still don't. I haven't found that everyone really understands what it means. I know folks that have outsourced that, so they don't really know. And it's not like the bank is saying, "Oh, this plan is realistic," or they're not doing
They
that.
get that, and it's okay, and then sits in a folder and is not looked at again for 10 years.
Yep. So for those folks who aren't financial folks, right? And who should help them with that financial plan? Is this where folks start hiring a fractional CFO, things like that? And if so, if that's the way to go, what's the best way to find one? How much can they expect to pay for one? Should this be an ongoing relationship?
Yeah, I mean, I'd love to work with acquirers because, right, they're starting. I'm not opposed to working with sellers either to help them kind of button up and hopefully get some more value for their company. But if someone is acquiring a business and maybe they're better at operating than they are on the financial side, I would love to have a conversation. You will find a mix of all kinds of pricing models and things. Um, Anywhere I would say from a few grand a month, maybe 10 grand a month, depending on what someone is doing. Some people will offer you kind of an a la carte menu and say, hey, I'm willing to help you with a break even analysis for X amount of dollars. Um, I have a retainer. It's usually about 4 grand a month. But we're gonna dive in. We're gonna understand where we are and then where we're going. And then I would say it depends on the business growth that let's say you start getting up to 25, 30 $50 million in sales, you need to start bringing on some full-time people to really help you on a day-to-day basis.
I think you're touching on some really great points, right? Surrounding yourself with experts who can plug into areas where a business really needs support. And how does someone really come to understand those areas? And I think you got to really take an honest self inventory, right? Like, so if I haven't done finance, yes, I have an MBA, right? I think I can speak numbers, but the reality is you might not have that lived learned experience in a small business. And so tagging someone like you in even prior to the process of closing so that when you hit day zero, you've got someone in the trenches with you so that you're not totally slammed trying to financially manage a company. And one other point that I'll make is that along the vein of being honest with yourself, right? If you don't have industry experience and if your advisors don't have industry experience because it's a niche industry, right? You're going to have to do some real digging to figure out what the key gotchas and need to knows are for that industry, right? So if I look at my own experience, right? Apartment locating is kind of niche. We're helping people find an apartment outside in. I'm like, okay, that seems like a decent service and we've got a cash conversion cycle. But on the flip side, as an owner, I'm like, I need to know where those leads are coming from. I need to know the margin on those leads. I need to know our cash conversion cycle, but also like, do we have any leverage in that cash conversion cycle? Do we have any pricing power? And so there's so many other areas that are the true areas in any particular industry. And you can only really learn as a searcher by doing the homework or having the industry experience. What do you think about that, Josh?
So that's amazing. I got a text last night right before I got in bed from a buddy that does real estate investing. And real estate has been slow. And so he's kind of looking at different acquisitions. And the last thing he said to me last night was, it would scare me to buy a business in an industry where I have no experience. I think I would agree 100%. I'm not saying you can't do it. Buying bigger with that probably helps because the owner is in the day-to-day a little bit less often. But if I'm going to I can't buy an HVAC company. I guess I could, but it would scare me that if all of my employees left, there's a huge key man risk that's not me. But it's one of my favorite diligence questions is for someone is just, how do you make money? Don't tell me what you sell or what you do. How do you make money?
What's a
And
good
that's
answer to that? Because they'll tell
sometimes,
you what they sell, right? Like, and that's not what you're
right.
looking for.
I've had a customer that's a wholesaler, and one of the thing, like what they think that they're selling is products. I'll tell you what they really sell is time and convenience for a contractor. They're holding product where someone can call them, and if a contractor is going to work on a home this afternoon, they can call, they can get the part, it's ready to go. So they think that they're selling these products, and that's part of it, but they're really selling the warehouse space and the time turnaround. But it's just like, do they understand how money flows through their business?
That's really hard not having industry experience, right? So we've just mentioned having a bookkeeper. The bookkeeper probably doesn't have industry experience. We also mentioned a tax advisor. The tax advisor probably doesn't have experience in that industry. Maybe they might have a few clients that's in the industry. And then typically separately, I'm just telling you what I see with clients. They have a CPA who provides answers to questions and annual tax returns. Like, I
Okay.
think ultimately that financial team is incomplete. It's incomplete. Who has the industry experience? Is the fractional CFO supposed to have it? Like, who should be that person that can provide some additional insight, particularly if that buyer isn't from the industry?
No, right. So my background is in banking. And even then, like there's no bank is going to teach you everything, but there's industry events and knowledge. There's American Bankers Association, there's the Risk Management Association. So there are other things you can get involved in, and it's the same for any industry.
Mhm.
There's landscaping events all over the country, but you need to figure out who is either local with you or they're not willing to share because they view you as competition, then find someone in a different region who's willing to kind of help you out and say, hey, here's what's going on. Here's really what you need to be understanding. I was just at a Michigan Ross held their ETA event, and a guy said, hey, I got on a plane and I flew out to Fargo, North Dakota to do industry research before I bought a business. Like I went and visited someone who was doing something similar so I could see on the ground what it looks like.
So if someone had to, let's say it's a sub 10 million revenue business, doesn't matter the industry. They should have a bookkeeper, which of course is outsourced, but who else should they have? Would you recommend them having? And let's say 5, not even 10, because 10, the owner is still out of the mix more than, let's say, a 5. They're involved in the day-to-day, a 5 million revenue business. Who should they have? And before you answer that question, another thing is the CPA and bookkeeper. Should they be at different companies?
So that's a little complicated. I think if someone does a review or audit, they can't be your bookkeeper. I think there's a law that separates that. So a lot of times the CPA firms will have consulting arms, but you'll never see them actually do transactions for you. So that there's some legality there on how that works. But I think once you kind of start hitting that $5 million range, you should start thinking about a controller level work. Someone should be putting together actual financials, and that includes a statement of cash flows, not just building out a balance sheet. Once again, your accruals at that level don't have to be 100%. Maybe a few dollars from payroll slips from month to month, no big deal. But you should really start thinking out, okay, we need real financial statements. But I wouldn't say that's necessarily a revenue number either. How fast are you growing? Do you have a feel for your business? There are a lot of things where like I can come in, I can set you up with a list of KPIs, and we don't need to talk every month, but we can kind of set you up and say, hey, like here are 5 things you need to track besides your financials. And then like maybe you get to 10 million and we have a further conversation.
So is there any trends or tools that you see emerging in the financial industry and cash flow management that entrepreneurs should pay attention to?
I think Kinza said it earlier. I mean, a lot of automation.
How do you see AI playing a part in this moving forward?
Yeah. I mean, I think like I wouldn't tell someone that bookkeeping is going to be around for another 10 years. I just don't think that it will be.
Yep.
Um, I think you'll have to with anything, you'll have to review those transactions to make sure but especially if you're running off a credit card, an AI can go in and match those. There'll be some things you have to review and move, but for the most part, and then like technology from banks, even like they can see your cash every day. So they know what's coming and going. A lot of it, I mean, JP Morgan's probably bigger than most people need or use, but I think their technology budget's $17 billion on an annual basis. They can kind of tell you from your bank account how things are moving, and it'll only get better. And then, I mean, there's all kinds of software programs now that you can plug in and they'll tell you pretty much all your KPIs, and you can create budgets. You can track via last year. So there's just a lot of software options today that people can use.
This has been super helpful. And I'm hoping that as business buyers or owners hear this, they understand that there's a lot more to the numbers and the dollars of a business. And we're not even talking about the business, right? So to grow, you got to have the numbers and stability down pat before you go buy more trucks, sell more work, supercharge whatever you want to quadruple the numbers that you're looking at. So I think for me, as I kind of process all of this, like sometimes we think success is to like wildly grow a company. And yeah, it absolutely is. But for the vast majority of people, I think success when you acquire a business is stabilizing it and understanding what you just bought and getting the team in a stable place as well. And then looking at growth.
I agree with that. I talk to a lot of people about let's capitalize your balance sheet before you try to grow. Let's make sure we have a foundation that, hey, if something bad happens, we can absorb that. And so whether that's 3 months of expenses in the bank account or 6 months, let's understand what we need. And then, okay, we want to start it to grow the top line, we can do that. But we know we have a foundation to grow from there.
Yeah. And on the foundation of growth or having a little bit of a cash cushion, how do you view a line of credit or a cash sweep as helpful tools in that process?
Yeah. As a former banker, I love lines. I think the only thing I would say is the more I'm in companies, the more I love credit cards just because you do get the 2% cash back. The only downside with that is you do have to kind of pay it back on a monthly basis. But yeah, I think having a line, eh, I'm on a variety of nonprofit boards, and most of the time we don't need to dip into them, but they're always asking me, should we keep it? And I say yes, because it's an insurance policy. Having a line, I mean, even if you don't want to use it, I think you should to kind of fund inventory and receivables, but having one is a lifeline, and understanding how it works. What's your availability? Is it based on AR, inventory, both? I think everyone should have a line of credit. And I would say never complete an acquisition without having a line.
Great advice. So, Josh, where can listeners go to learn more about improving their cash flow or working with someone like you?
Yeah, you can find me on LinkedIn. It's just Josh Tejjkl. I'm pretty active there. My firm is August Advisory, and it's augustadvisory.co. And then I'm also pretty active on Twitter. And I would say if you're not on there, I would get on Twitter. There's a huge small business community. I've met a lot of people from all over the country. And so if you have questions, if you're looking to solve problems, there are a bunch of people that are online that are willing to help you.
Well said. Yeah, we have a great community on Twitter. Well, Josh, I want to thank you for sharing your wisdom and expertise with the audience today. I'm sure it's going to help a lot of people. And all of your information will be in the show notes. Thank you for joining us.
Yeah, thank you. This was fantastic.
Thanks for joining us on the Acquisition Chronicles. Today's episode hopefully gave you some key takeaways and reminders. We appreciate you listening. And if you found value in today's discussion, please share the podcast with someone who might benefit. We'll be back next Tuesday with more stories from the trenches. So make sure to subscribe and follow along. Until then, take care. Thank you for listening to the Unpolished MBA podcast. To hear more episodes or to request to become a guest, please visit unpolishedmba.com.